Hey guys, welcome to another Ultimate Edge webinar series. Once again with Dave Herbst of CMG Mortgage, who's dedicated some time. We really appreciate Dave joining us today once again.
No, thank you, John. Thanks for having me.
Appreciate it. So this time, guys, we're going to do a little different. We're going to talk about the all-in-one loan as we have done with Dave in the past. I'm going to ask Dave for a little overview, but it's going to be kind of a brief overview. If you want more info, we have a number of YouTube videos, and you can give me a call at the end, and we can talk about it and go much deeper in it. But with the focus of this particular webinar is we're going to ask some frequently asked questions that I've gotten and some that Dave gotten in the past about the all-in-one loan, and we're going to grill Dave and let him answer them. So before we start there, Dave, please give for people who are not familiar with the all-in-one loan just a brief overview of what it is.
Yeah, absolutely. The all-in-one loan is, it's best described these days as kind of a cross between what's known as an all-in-one mortgage that are very popular in countries like Australia and Canada, New Zealand, even countries like India today use these types of financing tools. And also an offset loan. Offset loans are widely used throughout Western Europe. So the all-in-one loan that of course is available through you and through us is kind of a cross or a hybrid loan in between those products. Simply put, it's the combination of home financing and personal banking bundled together in order to essentially offer borrowers an easier method of paying down their mortgage balance more aggressively. And the reason why that is important to a lot of people is so that they can save money, right? Saving time and money, I think, is on the minds of most people. But it does it comfortably. It keeps you liquid with your money that you use to pay down aggressively, available to you 24/7. So in other words, you're able to access payments back. You're able to tap into home equity dollars over 30 years without having to refinance again, and you can pay off as fast as you want to. So that's what it is, and it's quite unique.
It is unique, guys, and it's a phenomenal product. So, which brings me to one of the most frequently asked questions that I get, Dave. So this loan saves the borrower a bunch of money if it's the right loan for the right borrower over a traditional 30-year fixed, 15-year fixed loan. So if we're saving the borrower a bunch of money, that means the bank is not making nearly as much money. So why does the lender even offer this loan when they could make more money potentially on another kind of loan?
Yeah, great question. We get this one very frequently, as you've indicated. Here's the reality. The standard mortgages that we've been using really for the last 90 years or so, right? The amortized mortgages, your 15-year mortgage, your 30-year mortgage. These are loans that were really put in place and offered first during the Great Depression era. The reality is that people tend to recycle their mortgage debt pretty frequently, and we believe that's a result of all the limiting factors that come with those instruments, right? You can't gain access to equity dollars. You can pay down more aggressively, but you can't get those funds back in case you need them. There's really very little control or even incentive offered on those mortgage products to pay down more aggressively. They really compute interest only once, end up charging you a lot of money. So there's a lot of limiting factors in there that kind of causes people to refinance often. For whatever reason, historically speaking, people tend to refinance or change their mortgage about every 5 to 7 years. I would even argue probably a little bit more kind of frequently these days as rates have kind of come down. So if we make somebody a 30-year loan, we're likely going to lose that customer in 5 to 7 years statistically. Okay. But if we make a loan program that actually creates an easier pathway to mortgage payoff and mortgage freedom, maybe in 7 to 9 years or even 10 years, completely paid off, then we're going to likely retain that customer, right, for longer, maybe all the way through payoff. And that's really the number one answer. Let me add to that really quickly. Because this loan also allows so much flexibility over 30 years, so you can actually access your equity dollars without having to refinance, it also has that kind of built-in potential for future borrowing needs. So if somebody wants to just maybe invest in real estate after they've paid off their primary, they can just write a check from this loan. They don't need to go get another mortgage to go do that. So there's kind of a lot of built-in, benefits that really keep the customer with us with the loan for longer. And that's really what's in it for us.
Okay, that makes sense then, doesn't it? Okay, the second two questions kind of come hand in hand that I've received from clients. They're related to the structure of the loan, Dave. So what we have here is a home equity line of credit, guys, which is tied directly to a bank account, and they function together, and that's how it works. So, but given it's a home equity line of credit, it's a variable interest rate. So question number one, or number two, I guess, for this webinar, Dave, is it's a variable rate. Shouldn't we be concerned about that, given that rates are so low on 15 and 30-year fixed right now? Instead of getting a variable, why not get a fixed rate?
Common question. Let me begin my answer by, kind of posing a question back. It's a question that I, coach people to ask and really kind of challenge the thinking, the kind of conventional thinking as it relates to mortgages. What's most important when you're borrowing money, especially utilizing a mortgage, right? You're looking for home financing. You're committing yourselves to years worth of debt. What's most important to you? The interest rate that actually comes with your loan, or the amount of interest you pay on the loan?
Good point.
Right. And I think that a lot of people would actually argue the real money you've got to make and then spend, right, to pay for your financing matters more than just the rate alone. So this loan really tackles that. It doesn't focus exclusively on interest rate. And instead, the best hedge, the most powerful hedge we have into reducing our cost is actually attacking loan principal, paying it down more aggressively. The big question becomes, how do I do that comfortably and confidently and keep my money liquid? Well, this loan solves for that, and a conventional mortgage doesn't. And so it's really about the math, right? If the rate on this loan is higher on average, could you pay off your house in 7 or 9 or 10 years versus being in debt for 30? If that's possible, is that better for you? Will it save you money? And if it does, then rate matters least financially, mathematically, logically. And such is the case, even, John, when you invest money. There's really only 3 variables at play. Only 3 variables at play when you're managing money. And that is your principal balance, your loan's interest rate, as well as the amount of time that you're in debt. Okay. So if you can reduce the amount of time you're in debt by attacking loan principal, you can have a higher rate and save significant amounts of money. And that's really what this loan is engineered to do, without a dependency on rate. Therefore, you're not chasing it every 3 to 5 years and refinancing. You don't need to do that with this loan.
Okay, good. But the corollary to that question is the maximum rate. What is the maximum rate, and should I be concerned about that, Dave, that the loan's going to crank up to the maximum and cause me problems?
Sure. So let's talk about the rate structure very briefly. The rate itself has 2 components, right? As you put it, there's the index, and we leverage the 1-month LIBOR index currently, which is low, very low. It follows the federal funds rate pretty evenly. It's approaching 0 or very near 0 again %. Then there's a margin, and that margin is locked in. The customer locks that in, and it doesn't change throughout the loan's term. And so the rate can fluctuate on a monthly basis following the 1-month LIBOR, wherever it goes. We know that the LIBOR moves very slowly. It's very predictable, again, because it's really tied to our monetary policy here in the United States. But the maximum it can go is what we refer to as a lifetime cap. That lifetime cap is set at 6% over the initial rate that you get on this loan. And let me be a little bit more specific. We also have a lifetime floor on the loan, right? So, because at one point it doesn't make economic sense to charge people 1% on a loan when maybe our borrowing costs are higher than that. So there's a floor rate on this loan of 3.75% currently.
Okay.
And so the lifetime cap is set at the greater of the floor rate plus 6%, or your initial fully indexed rate, that's LIBOR plus your margin plus 6. Okay, so it's the greater of those 2. And what that means is you're talking about floor lifetime cap rates that are about 9.75 to 10 and a quarter right now. Now, when's the last time the fully indexed rate has been up that high? Maybe the month or the first couple months that LIBOR was adopted back in 1986 as the world's benchmark overnight rate. Maybe. I don't think it was actually that high. I think it was a little bit lower than that. Since then, rates have been coming down. There's cycles, they go up, they go down, but LIBOR, along with most short-term rates, have been trending downward as the global trade economy opens up and has opened up, and we take on more debt. Short-term rates tend to stay very low. And so anyway, that's how the lifetime cap is. Should borrowers be concerned about that? Well, the best way to test drive that is just about the math, John. You know this. So as you know, we've engineered a simulator, a calculator that helps customers preemptively understand, would they still be able to save money and time if the rate does go up? And of course, that's found at aioloan.net, aioloan.net. It's a phenomenal tool, and it tests suitability and financial benefit.
Good. Which brings me to question number 3, Dave. You led into it really well there. The simulator, a great tool, but how accurate is it? How much can the client trust it when they put the information in there that it's going to reflect a real answer to their situation in terms of how fast they're going to pay off their loan?
Sure, absolutely. So the simulator is very robust. It's you probably wouldn't know about when you visited it because it's extremely easy to use. But a lot of thought has gone into developing our simulators. This is actually version 3 that we have online today.
Okay.
And we're refreshing it currently, and we'll have that available in the next 30 days or so, condensing it a little bit. But it's a very robust simulator. It really is designed to capture. It's a comparison tool, and I think that's important to understand. It's a comparison tool. You're not just throwing in, here's what I make, here's what I spend, and boom, we're telling you what you can save on our loan. It's really designed to compare net tangible benefit and ability to manage it and save money, even if rates go up, compared to a traditional loan. As you know, John, you don't put this loan in place for somebody that won't benefit from it financially.
Quite right.
Right. And so it's designed to really stress test every single scenario in a very conservative manner. What's programmed into it is that the rate is going to go up. That's not happening today in reality. The rate is actually falling. But we programmed it by design to actually have the rate increase pretty dramatically on a month-over-month basis until it hits its 25-year average. And we keep the rate there in the simulator for the purposes of testing suitability. We keep it up at that level indefinitely. So in other words, every single scenario is tested as if the rate were driving up to 6.5%, and then staying there indefinitely. When you compare that to a low rate 30-year fixed or 15-year loan, and you're still able to save tens, maybe even hundreds of thousands of dollars in interest costs, it's going to showcase that. It's extremely accurate. It really takes in consideration periodical expense habits that are tracked by the Census Bureau. We've leveraged that information and understanding and programmed the calculator with all that in mind. And it really is intended to capture that information. And we even buffer the results a little bit because we know that there's certain months that are longer than there are other months, right? There's actually 4 months each year that have roughly an extra week in them. So your spending is going to be higher relative to your income those months, right? That's all programmed into it. Holiday months, vacation time. We know there's going to be spikes in spending, and that's information that we've gleaned from the Census Bureau. So it's all that understanding that's actually been programmed into the simulator, and in order to provide a result that's extremely conservative. Let me touch on one extra thing here. The vast majority of the clients that take out the all-in-one loan and have it today are paying down pretty aggressively. The average principal reduction rate per year is about 12.4%. 12.4%. And it's historically been about 12% for the last 15 years that we've had.
Wow.
In the simulator, there's a line item that actually shows you that what the forecasted reduction in principal is annually. And oftentimes you're looking at numbers around 8 or 9%, which is dramatic. It's double the speed of any traditional mortgage. But what I'm saying is, in reality, we're seeing payoff even faster. So simulators designed to give you a really conservative forecast and really stress test financial benefit, even if the rate were to go up. And you can expect those results to kind of under promise and in a sense over deliver, right?
Good. And guys, if you want a little bit deeper look at some of the real world results, we did another webinar, which is on our YouTube channel, and I'm going to put a link on this video here, and you can link to it. And we asked Dave about real world results, and he read us a bunch of letters and stuff from people that have gotten the loan after having run the simulator and the impact to their financial situation in their lives, and they're pretty dramatic. It's worth checking that one out. All right, Dave, that leads me to another question here, and that is, I know that there are plans in place to replace LIBOR, guys, that's the London Interbank Offering Rate, as an index with something. And should we be nervous about that? What's the new index, and And how's that going to change the loan?
A great question. No, nothing to be nervous about. Although you wouldn't really glean that from reading in the headlines. I think I think the mortgage industry is pretty dry with news. I think for the average American, right? So I think that those that report on the industry tend to try to hype a lot of this news up to make it a little bit more exciting, right? And this is one of those areas I believe is not that exciting. It's historically we've seen mortgage products, in the indices used for mortgage products kind of come and go, phase in, phase out over time as the entire global economic environment changes, right? Things change over years. So the 1 month LIBOR and the LIBOR in general has been used as the overnight benchmark rate by banks, by the vast majority of banks, globally speaking, since January of 1986. And we've seen a lot of changes, not only here in the United States, but globally in the banking industry, in mortgage, of course, housing, with monetary policy set by any one country's central bank. A lot of changing has gone on over the past 30, 35 years or so. So, it's just one of those things that is due to probably shift a little bit. Here in the United States, our Federal Reserve has indicated their intent to transition conventional ARM programs, adjustable rate mortgages, like your standard 3-1, 5-1, 10-1 ARM that you can still get and that is supported by Fannie or Freddie. Those products will migrate over from LIBOR over to what is called the SOFR, or SOFR, the Secured Overnight Financial Rate. And there's a lot of news online about that everybody can read. So that's what conventional mortgages, ARM mortgages, are going to migrate to. The all-in-one loan, like many other programs out there, it's a portfolio product. This is not sold to the agencies. It's not sold on the open secondary mortgage market. It is held on the balance sheet of one of many of our partners, bank partners. And really, it's up to us to make that decision whether or not we're going to migrate away from the LIBOR. It's not being discontinued altogether. It's likely going to continue on with banks leveraging it still. But we'll likely migrate from the LIBOR early next year to probably the Treasury rate. And the reason for that is, John, we want to make sure that the all-in-one loan specifically really leverages an index that tracks very evenly with our federal funds rate, which is, of course, used to set monetary policy. That makes it very predictable. And the Treasury rates move nearly identically with the Fed funds and also the 1 month LIBOR historically, and they're very low. Very predictable. We're able to understand how it moves based on its past. So that's why we'll likely move towards a Treasury rate and leverage. So there'll be no cause for concern if and when we make that decision and begin to migrate. We'll communicate that to current customers. Of course, they'll get a notification, an advanced notification, and the transition will be seamless. It'll be overnight. There'll ultimately really be no change to their loan structurally at all.
This reminds me, Dave, another question related to the HELOC portion of this. We have the HELOC in the bank. I'm going to switch to the bank here in just a minute. But in regards to the HELOC, the interest is calculated in kind of a unique way, I believe, and in particular compared with other HELOCs and everything. Can you describe that for people? What's important about the way the interest is calculated on the all-in-one loan?
Yeah, absolutely. This is one of the biggest driving forces of the product. Unlike a standard conventional closed-ended mortgage, your 30 or 15-year, which are amortized loans, meaning that interest is calculated only once, right, based on your original borrowed amount. That's it. As you pay down a standard mortgage, it doesn't recalculate interest based on your lower principal. It doesn't do that. The all-in-one loan does that. It does that nightly. Traditional HELOCs don't always do that either. There are some out there, but the vast majority of home equity lines of credit that are sold traditionally compute interest only once a month based on your average monthly balance. And it's an important distinction to make because the all-in-one is designed to really help you drive your flow of cash flow, your income dollars in and out of it. Essentially, it's the combination of banking and home finance, right? So as your money sits idle, waiting to be spent on your regular bills and expenses, the daily recomputation of interest is engineered to save you money. It's engineered to minimize each day's interest cost so that it computes the smallest interest payment due each month. So that's a real special feature. It's a nightly recalculation of interest based on your unpaid balance. That's how that works.
Okay, got it. All right, let's switch gears a little bit. The other side of the all-in-one loan is the bank, the servicing portion of it. Remember, guys, they have the HELOC, the home equity line of credit, which Dave has talked about, linked directly with a bank account. Let's talk about this bank account. It's not a bank that you go down to the street corner on and pull your cash out from their ATM. Is it, Dave? And does that limit people if they want to pull cash? And what is the bank? What are the features of the bank account?
Sure, absolutely. It's a full feature checking account. It's a checking account. This isn't fintech that looks like a checking account, but it's not, because there's a lot of HELOCs out there that have that applied as well. This is a real checking account. It just also happens to be what's called a sweep checking account, or a zero balance checking account. It's engineered to provide all the same access features and security as any traditional checking account. So it gives you the ease of use and ease of access to your income dollars to pay your bills with. But what's unique about it is the day that you make any deposit, this checking account automatically sweeps those funds in its entirety into the HELOC and applies those dollars to the principal. So every time you make a deposit, you're making a principal reduction payment towards your HELOC. Yet those dollars are kept liquid for you for use, right? And because of the daily interest recalculation, you're saving interest. And yes, you're right. These are the two banks that we leverage on a national basis. Are not on every single street corner out there, but they're nationally chartered, FDIC regulated and insured institutions. We have deep partnerships with them, and they're very established, well-capitalized banks. One of them is North Point Bank, and they're up in Grand Rapids. That's their headquarters. I believe they have about 38 or so branches nationwide. So again, not on every street corner. The other bank that we leverage is called Merchants Bank of Indiana, and they're just outside of Indianapolis and Carmel. And phenomenal institution, both these banks. So all the features come with it: check writing, online banking, bill pay, mobile banking, check imaging with your mobile app. You can link external accounts to it. ATM debit Visa cards come with it. There's no transactional fees for use of it. It's not engineered to charge people money. It's engineered to help people leverage their income dollars and save interest costs. So it's much like most banks today, where they promote the virtual banking environment, where you're able to do things virtually all the time. One subsequent question that we get, John, is, should I go close my current bank account down the street? And no, of course not. Don't go close. You don't need to. There's no requirement to use this as your primary checking account. It just becomes a more effective and efficient way to manage your income, right? Your idle money. But there's no requirement to use it that way. So it's really up to somebody's comfort level and the benefits that they're going to glean from their cash flow behavior. They can still utilize their checking account they use today for those bills and stuff, but it functions the same.
There's a concierge service involved with this, Dave. Can you talk about that a little bit, please?
There is. There's actually a couple. So at our servicing partners at the banks, they have separate teams that manage the all-in-one loan specifically. So it's really cool, because I think we're all used to calling into a bank and asking questions, whatever it may be, right? I've lost my ATM card. I have a question about an expense on my statement, and sometimes it's hard to get through to somebody, right, without having to go through an automated system forever. And even then, the person you get on the horn doesn't necessarily know a lot about you. The all-in-one loan experience is a bit different. When you call in for whatever reason, maybe you're ordering checks again, you can do that online. But if in case you need to call into the servicing department, they are all-in-one loan trained professionals. Then many of them have this loan themselves. They understand that the checking account is tied to your mortgage debt. And there's a lot going on, right? And so they're trained to encourage the use of it so you can save. They understand the types of questions, such as, can I link a business account to this loan, to my checking account? Can I send you cash to make a deposit? All those questions. The customer service reps understand why you would be asking that, because it's tied to the loan. It's unique. Also, at CMG Financial, we also have a client liaison group that acts as kind of the intermediary in between the servicer and your loan officer, so that they can really understand what your goals are and make sure that you're getting the right loan for the right purposes. And you can rely on them as well. They know the loan. Many of them have it. And a lot of them, we also have limited access to the account after it closes, but we can certainly direct people in the right place and answer anecdotal questions.
Okay, good. Two more main questions I get, Dave, that are kind of follow-up here. Like, why hasn't this loan been available longer than now? And has it been? Is it hidden or what?
Yeah, great one. It's kind of one of the best kept secrets out there. I think we get that all the time. So if you really think about it, most of the lending activity that goes on throughout the United States is these days is really sponsored by the government agencies, what we call the agencies, Fannie and Freddie, or they might be insured by the VA. Either way, it's conventional lending, and if you're not familiar with the definition of that word, it really, to summarize, it really describes one size fits all, right? So they've created a box, and and some guidelines for the box, and if you qualify for that box, everybody gets the box, even though we're all very different. We're all very different in our money and our obligations and our goals. So I always find it fascinating how and why we continue to put everybody in this singular box in structure, even though we're all very different, right? It doesn't make sense, but it's been this way since the Great Depression era, and it's really hard, I think, to change that banking grain. I do believe that this type of financing, and I'm not just saying this because I'm biased, because I work for the organization, right? I'm not just saying it. I'd love other lenders to adopt and embrace and launch their own, version of it to make this more of a mainstream product to really get the word out. I really do truly believe, John, that this loan has the power to reshape, the housing economy and get people out of debt sooner, which makes them live more securely. I think it could really change the way things are financially for us as a nation. But it's against the banking grain, to pay down debt. That's a new idea, I guess. That's so different from regular mortgages. So that's ultimately why we became familiarized with the program a little over 15 years ago, around 2002, and fell in love with the concept, and just decided that this is a really good cause. It's something that would really make a lot of sense for millions of Americans, tens of millions of Americans probably. And if we can help people save money and time, it also reduces risk in lending. So it's good, for not only the customer, but also us as a lender, and you as well as a mortgage broker and lender. And it's just against the banking grain. It's hard to change things, but it's sure to happen. I'm sure of it.
All right. So last question I have before I'm going to give you the opportunity, Dave, to kind of throw in some stuff here. But one of the big questions I get is, what is the downside of this loan, and who's it not made for?
Yeah. So this is definitely a loan that's engineered to benefit households that are cash flow positive on a monthly basis. So routinely don't spend more than they make, right? Obviously we can't get very far in life financially that way. But there's, if you kind of think in terms of a spectrum, financially speaking, with personal finance, there's those households that really are struggling to make ends meet. Maybe they are slightly cash flow positive. They're not spending every dime they make, but they're really close to paycheck. They may be able to afford their mortgage or their rent. And then on the other side of that spectrum, there's those households that are, very cash flow positive, live well within their means. They're established financially speaking. And so if you think in terms of that spectrum, this loan is really beneficial for those people who lean more towards the cash flow positive, being, at least 10% cash flow positive, meaning that your current bills and expenses, including your mortgage or your housing expense, don't exceed 90% of your income. Okay. So that's really kind of the threshold that we see the benefit either reduce or improve when people are cash flow positive. So who it's not right for are those people that are I think less established, maybe overspending slightly and they know it. They could cut back, but they haven't quite done that yet. The 30-year loan, the amortized loan, is really intended for that household. It still has its place, of course. But for those people that are cash flow positive and start to really kind of make, payoff of their mortgage a goal, and and live within their means, this loan is a potential, it could be the right loan for them.
Got it. Great. Dave, I want to give you the opportunity, because I know that you're the advocate for this loan. What questions should people be asking about this loan? What are the questions you hear that we haven't talked about?
Yeah, great question. I think we get tax deductibility. Is this loan still tax deductible? That's kind of an obvious one, right?
Good one.
So, briefly, there was a lot of misconception, I think, with the new tax laws that were put into place with the administration that eliminated what was called home equity indebtedness deductibility. And what that meant was that we could no longer leverage equity dollars, regardless of what kind of mortgage you use to do this. We could no longer take out a mortgage and use equity dollars to go buy something and actually increase our debt beyond its original acquisition level, right? So if you buy a home for $500,000 and then you take out a 30-year fixed and cash out some equity dollars 5 years later to go buy a car, we used to be able to deduct interest paid on up to $100,000 of what was called home equity indebtedness. That was eliminated. That doesn't mean that home equity lines of credit are not eligible for deductibility. They are, of course they are. It doesn't matter what type of mortgage product you have. What matters is how your mortgage debt is applied and how you're using it and managing it. So this loan is deductible. It's eligible for deduction. It just depends how you use the mortgage, just like any other product out there. Good.
That's a good question. I get that one too. So thanks for bringing it up. Any other questions? Any other thoughts?
I think that I find myself going pretty deeply into routinely is, if I am paying my bills and expenses, right, from this loan, right, I've embraced it as my primary checking account, and I'm now using it to pay down aggressively, to save some interest each month and annually, but I'm also paying my bills from it. So I'm elevating my balance as I withdraw money.
Right.
How does it actually pay off earlier then, right? Because I think a lot of people naturally go, that's great, but I don't know that I'm going to keep a ton of money, right, in this loan, or does it require me to have an enormous amount of savings that I just dump into the loan and that's how it pays off?
Good question.
That's not the case. It's really driven by all that activity, right? It's not just one thing you do. It's really all of your banking behavior that is really leveraged by this loan structure. So there's a few things that go on. One is that initial deposit you make into the all-in-one loan checking account will sweep that day and pay down your principal by an equal amount. That saves you interest that day and all the subsequent days following, depending on how you manage those dollars, right? From there, you don't have to make a mortgage payment. There's no P&I payment you're now having to send off to a lender. You've in effect already done that by making your deposit. That's a huge part of this. So think about that. If you're no longer having to make your current P&I payment, the one you're making right now on your mortgage, where would those dollars reside naturally? Probably in your checking account, right? If in this checking account, they've already been applied to your principal. So this loan converts a P&I payment to a 100% principal payment. And then you retain those dollars. It's huge. So think of those dollars month over month compounding the reduction of your principal and your savings, right? The third layer is even as you spend money towards your bills and expenses, those dollars aren't expensed or used on one single day every month. They're spent periodically, right? So we may go grocery shopping, or I may have to go fill up the gas tank, or pay a utility bill in a couple weeks. But for the most part, a lot of our money kind of sits idle waiting to be spent on our regular living expenses. And while it sits idle in this account, it's saving you interest at the rate of the loan itself versus sitting in a checking account earning you nothing. And that's also what adds to the benefit and adds to the savings. So it's a combination of things. Then of course, if somebody has extra savings in a checking account or savings account or money market account today, and they want to deposit that in a lump sum, that'll help to obviously reduce the principal balance, but yet those dollars remain accessible.
Dave, I got to tell you, great answers or good questions. You've covered a lot of ground here. I appreciate it very much. And appreciate your time once again.
John, thanks for having me. I appreciate it. I look forward to the next one that we do.
Yeah, sure will do it. Guys, we obviously have a really good relationship with CMG. If you have any questions on this, give me a call. My information will be on the screen there. Talk to one of our loan officers here. We lend in different states. We do this, not in all the states. But if we don't do it where you're at, we'll just direct you to somebody through Dave that can help you out. And if we can help you, we certainly will. We believe, as you can tell from this webinar series, in educating our clients to the best product for their needs. The all-in-one loan may or may not be the best loan for you, but we'll help you find the right answer. I assure you of that. So give us a call if you have any questions. Dave, once again, thanks for your time. I appreciate it very much today.
Thank you, John.
All right.